I never really understood the concept of positive cash flow properties. Let's take as an example a property that has a positive cash flow of $100 a week, which is pretty good. That adds up to be about $5,000 a year. Whereas if you pick a property for capital growth reasons, it's not impossible to find something that will return 2, 3, 5%, which will add 30, 40, 50, 80 grand per year. It just seemed a much better proposition to buy properties that focus on capital growth. And offer, it seemed like it was one or the other. You picked something in the country that had a good cash flow, or you picked something in the suburbs or in the city that possibly was new, that had good capital growth, but it was kind of one or the other. I must say though, I can see now that there is an argument for both. At the end of the day, and this is very crucial to understand, you're not trying to replace an asset. You're trying to replace an income, your salary, when you retire. So it is cash flow that you need when you retire. Sure, you can focus early on in your portfolio building on properties that have good capital growth because your expenses might be low, you're a single person, you've got the cash flow to supplement any shortfall and build that portfolio, and the equity will help you grow your portfolio. But at some point you need to either transition that or you need to incorporate into that a cash flow aspect, and you need to use those assets to build a cash flow generator that replaces your income. Because when your income is replaced from your investments, you're free to do as you want.